Hey, welcome to today's video. This is video number 2 in our complete guide to RRSP investing. This is going to take you through, how to open and set up an RRSP and what areas you should pay attention to when you're filling out an application and why you would want to set up your RRSP in a certain way. I'm going to lead you right through to that. And we're going to go all the way up to just before we talk about contributing to your RRSP. So we're going to lead you up to just setting up an RRSP, and then, okay, how do you contribute? And then we'll go into another video about how to actually invest, what kind of things to put in an RRSP, and so on. So I hope you enjoy this video. If you're new to the channel, again, my name is David Aaron of Aaron Wealth Management. And on this channel, it's an educational channel for everything about investing in retirement accounts, TFSAs, non-registered accounts, how to save for some of your goals, life insurance, retirement planning, estate planning, all these wonderful things, and I answer your questions through videos. And obviously when you make comments, I answer your questions as well. And your comments are actually very useful because I'll take some of those comments and make a video about it. So please feel welcome to comment on the videos and like and share. Of course, follow my channel. Let's talk about RRSPs and setting up an RRSP today. So in RRSP, there's actually two kinds of RRSPs. One is called obviously a registered retirement savings plan. This is something that you as an individual would set up for yourself, or that you would contribute to, and it would be your retirement account. And you can set up an RRSP just about with any financial institution. You just walk in or call them up or go online, and you can start an RRSP. It's fairly simple to do. There may be some minimum amount of money that you need to contribute to begin an RRSP. So they might say you need to deposit $500 or you need to do $50 a month. They'll tell you what is the minimum for you to begin an RRSP. So basically you talk to an advisor or the financial institution, and they'll walk you through that step. And then the other thing will be they'll begin telling you about what you can invest inside of an RRSP. You'll need a social insurance number because it's a registered plan and the government needs to have that attached to your RRSP account. And you'll need some kind of government ID that's not your social insurance number. So a passport or a driver's license are typical kinds of ID to use to open an RRSP. There are two kinds of RRSPs. As I said, there's your RRSP, Registered Retirement Savings Plan, and there's also called a Spousal RRSP. Now, the Spousal RRSP is one that you set up for your spouse or common law spouse so that you can contribute to their spousal RRSP, not their RRSP, because they might also have an RRSP. You're contributing to what's called a spousal RRSP. Well, so it's SP RRSP. And it's no different than the way that it works is no different from the way you would have your own RRSP. It doesn't create extra room for you to contribute to. When you make a contribution to your spouse's RRSP, so your spousal RRSP, it's based off of your own contribution room. So it has nothing to do with your spouse's contribution room. So just be sure that you understand that going into that. 'Cause some people think, oh, I get an extra room. It doesn't work like that at all. But the benefit of it is you're still lowering your income tax, right? So instead of you contributing to your RRSP, you contribute to your spouse's RRSP, and you still have the benefit of that tax deduction when you file your income tax. Now, most financial institutions are very friendly when it comes to technology, so you can easily grab your iPhone, your tablet, go online, and you can open up an RRSP, and then you can also begin talking with an advisor over Zoom about their particular investment. Now, there's no minimum age to open an RRSP. A lot of people didn't know this, but as long as you have a T4 income, you can go ahead and open an RRSP and begin investing. This is really important because it's the earlier you can put money into a tax-deferred savings plan, the better it's going to be for you, because this is going to help someone invest earlier. So for a young student working, making decent money, part-time income could be as much as $20,000 working in a mall, selling clothes, or going to a grocery store, whatever that job is. Your 15-year-old might earn $20,000 part-time. And in that case, they'll be looking to try to save some money in taxes. It won't be a lot of money. It'll be 15% of their tax rate. But the idea here is that it's creating RSP contribution room. And if you can put some money away right away and start earning on that in a tax advantage way, awesome. Okay, let's talk about naming a beneficiary. When you go ahead and name a beneficiary, it's typically, if you're married, you're going to name your spouse. And why is that? Because the government has what's called a rollover provision, which allows you to move at your passing all of your RSP balance straight on over into your spouse's RSP. And this is not a taxable event because it's an exemption, if you will, in the tax code that allows you to roll over your account to your spouse with no taxes. It's not considered a contribution, and it doesn't create or affect any contribution limit to the person receiving the RSP. And so this is very important that you name a beneficiary. If you name a child as a beneficiary, things change a little bit. First of all, if you name a minor child, they have to have a trustee. This trustee can be anybody that you want, as long as it's not another minor child. They would be responsible for the money, and they could even create an investment account on behalf of your minor child, especially if the child is really young and it's going to be a long time before they can legally have all of that money. So they might as well invest it to try to make more money for that individual. So I'm giving you a hint here. That trustee has a lot of power, and they could be investing their money. So the question is, I hope that trustee, whomever you choose, is knowledgeable enough to get good advice. So be careful about who you choose as a trustee. Now, here's another pro tip. If your child has a registered disability, this is an excellent way now for you to save on taxes if you don't have a spouse. So let's say your spouse has passed and now it's just yourself, but you do have a child. And that child might be under 50, and I'm saying it for a specific purpose. If you open a registered disability savings plan that's called an RDSP, I'm not going to get into that. That's a separate video. But the idea here is it's a savings plan designed for someone with a registered disability. Well, the rollover provision is the same as if they were a spouse. So your entire RSP at your passing would roll over into the RDSP for that particular child, and there's no taxes paid. So this is a great estate planning tool. So if you are a married couple and you have a child or several children with a disability, consider opening an RDSP. Ask your financial institution if they have them, and start thinking about how that might be a useful estate planning tool for you. Okay, now, next thing, naming a beneficiary or not having named a beneficiary. So you open an account and you forgot, or the advisor didn't notice, or you weren't sure who to name as a beneficiary, and now you don't have a beneficiary on your account. So what happens at your passing? Your RSPs would, I should back up and tell you, if you name a child, then at your passing, your RSPs would be sold for cash. Then that cash would be put in trust for your beneficiary. But prior to that, taxes would be paid to the government because there's no rollover provision if they're not in an RDSP and it's just a child. Well, then the RSP is deregistered. It's sold for cash. CRA, Revenue Canada, gets their tax from that account, and then the rest goes in trust for your minor child. Now, what if you don't have a beneficiary? Well, some similar things happen too, but it's even worse. So the situation here happens is that your money, your RSP, gets sold for cash, and that cash, again, Revenue Canada gets their percentage. Now, because that money is placed in your estate, it becomes fully probatable. So that's 1.5% over 50,000 becomes a 1.5% fee to pay to the government just for it being in your estate. And then your executor is allowed to, well, I know a lot of families will name one of their children as an executor and they won't charge a fee, but let's just assume it wasn't a family member. They're entitled to about 5% to administer the settlement of that RRSP into your estate, and then eventually the distribution of that money to the beneficiaries of the estate, the heirs of the estate. So bear in mind that's 6.5% of your RRSP money going out the door because you didn't have a beneficiary and because your money landed in your estate. The other thing is too, once the money is in your estate, there's delays because it has to be probated, it has to go through that process. That could take anywhere from 3 months to 6 months, even longer depending on if there's any disputes with your estate and with your will. So better not for it to allow it to land in your estate. Now, what are your retirement options when you have an RRSP? Well, this is when we're talking about receiving an income, right? So when you open an RRSP, they're going to ask you 2 questions. And one of the questions is, how would you like to receive your income when you go to retire? And one will be either a RIF, or the other will be an annuity. Now, a RIF is, as I said in the very first video, is you converting your RRSP to an income stream, which is called a registered retirement income fund. This is where you would receive a monthly or annual income stream, and that income stream would be provided to you, tax would be taken off, and it would be deposited into your checking account. Pretty simple, straightforward, right? You pay income tax as you make withdrawals. In an annuity option, you're taking your entire balance and you're transferring it to an insurance company. That insurance company is then going to give you an income stream, and proportionally taxes will be taken off as you receive that income. But the difference here is that, one, you're not investing anymore. It's not invested in any market. It's just an income stream that the insurance company is going to give you. And they base that income stream off of a very low rate, usually really, really low. So whatever the, I'll say GIC rate is, it's slightly higher than that, but it's typically a low rate. But the benefit here is, and you say, what is the benefit of an annuity, especially with rates when they're so low? But think about someone who may not be very good with investing or may not be good with money, and it's better for them to receive an income stream that is more predictable. In a RIF, your income stream is always going to vary because your balance might get lower over time. You have to take out more of your money as you get older, whereas an annuity, it's a set amount that comes out every single year, and so it's easier to plan with. It's not invested in the market, so you sleep better at night. You don't have to worry about these market fluctuations. But it also might be better too if you have a history of living really, really old ages, like well above 95, well above, I mean over 90, we'll say, because the government of Canada expects for you to use all of your RRSPs by at least 92, because the withdrawal rate is so high that you need to be getting more than 20% on your money to make sure you'd never run out of an RRSP balance. So it's designed, an RRSP is designed when it hits a RIF to eventually have zero balance in there at around 92, 93. So if you live older than that, then an annuity might be better for you, because the way that they structure an annuity is that they think you're going to pass away at the mortality rates in Canada of about 86 years of age. So if you live older than that, then that's money that they're going to have to pay you, meaning the insurance company is going to have to pay you, because they expected to pay you all of your money by the time you're around 86 years of age. So if you have older ages, you can get some free money from the insurance company, whereas if you had in a RIF, you might run the risk of running out of money. So those are 2 options you should consider when you talk to an advisor about whether you should have an annuity option or a RRSP option. Does that make sense? I hope it makes sense to you. The next part, and we're almost done, the next part of setting up your RRSP is understanding the financial institution wants to know where this money is coming from. It happens and especially after 9/11, they want to make sure, is any money coming from any governments that are on a list that we can't deal with, or money laundering or terrorism. They want to make sure that the money is coming from legitimate sources. So they're going to ask you, what kind of employment do you have? What is the title and occupation? They might even ask you how long you've been doing that for. And I say generally they ask you this question is just because they want to make sure that they understand where the money is coming from. And an RRSP is supposed to be coming, the point is that it's based off your employment earnings. So even if you don't have any savings, because you have a lot of expenses maybe early when you're younger, and you may not have any savings, what happens is your contribution room continues to build, right? It's a cumulative effect. So whatever you have after 1 year of having T4 income, if you didn't use RRSPs, that gets added to the next year and next year and next year. So similar to a tax-free savings account, that cumulative effect. So you're still building RRSP contribution room. So when you do have money to invest, you could either borrow against it. So that's not really employment earnings, but you have that space to fill up that was based on employment earnings, okay? So this is sort of how that works. Well, that is video number 2. Really simple, straightforward. We're actually going to go now into the next video, which is contributions and withdrawals. This is a really good one, and I hope you're going to enjoy it because it goes into explaining exactly how do you contribute, the strategies around dollar cost averaging, and I'm going to save that for the second video, or whether you do lump sum contributions, how to withdraw money out. It's going to be a great video. I hope you enjoyed this video. Please remember to like and share and follow my channel, and I look forward to seeing you in the next video. Thanks very much.